We'll talk about the merger in just a little bit, but I want to focus on what Sophie was talking about in the markets, because it's been quite fascinating. Beginning of the year, it was stronger dollar, higher bond yields, U.S. fiscal policy that was driving the markets, and you kind of look at it now, it's just completely changed. We have no fiscal policy yet from the U.S., weaker dollar, lower bond yields. How do you read on all of that? Is that still going to be good for EM?
Yeah, I think so. I mean, clearly, people think Trump is good for markets in the U.S. I think if the U.S. booms, the rest of the world, if the U.S. grows, the rest of the world grows. So I do think it is good for EM.
Do you see anything that's mispriced at the moment then, Martin, in the EM space?
Not in the EM space. I think probably more developed market bonds rather than EM bonds, I would say. So you look at somewhere like India, really good value, local currency there. So I think I think EM's okay relative to developed markets.
Why do you think that is? Is it just because the whole dynamics of EM has changed so much now? It's not so much about commodities, but more so about tech these days. It's more about iPhones and iron ore, as one guest had told me this week. Is that what's really going to be driving the sentiment? Yeah,
a lot of it's about domestic growth as well. So you're investing in emerging markets to get the benefit of the domestic growth as well as the export-led businesses. So I think they've got the best of both worlds, the emerging markets.
Martin, I'm curious, and I want to bring up a chart here for our viewers. When we talk about the U.S. markets and EM, or the U.S. markets and the rest of the world, this is #BTV175. When you normalize the MSCI U.S. and World Index, Martin, it's so interesting, right? I mean, the U.S. equity markets almost seem indistinguishable, as this chart says, against the rest of the world. And it used to be, the idea is that at least you were in the U.S. because it was the cleanest shirt in the laundry of the world, and you wanted to be here with the rate differentials. Is that now a thing of the past? Is that turning into a thing of the past here?
Well, I think the global markets are catching up with the U.S. markets. I think U.S. have had a great run over the last 4 or 5 years relative to emerging markets. So I think it's the rest catching up more than anything else. I know the rest of the world is not just emerging markets, but they've had a pretty torrid time over 4 years compared to the U.S. So I think it's mean reversion, and the rest of the world doing better.
But the rest of the world catching up. But does it also mean that the U.S. is running in place, so to speak, right? Especially given some of the mixed picture you're getting out of the U.S. economy.
Well, I think the U.S. economy is doing pretty well. I mean, I think whenever I speak to people on Wall Street now, the heads of the big banks and so on, they're very happy with the way the administration's going, and more positive than I've ever seen them or seen them in the last 10 years. So in that respect, it's I think still going okay, but the rest of the world is sort of catching up and benefiting from it.
And Martin, your views on China, I think you've always been quite bullish. I know you just got approved your wholly foreign-owned enterprise presence there, so possibly some more opportunities in the mainland for you. But how do you view China at the moment, given this? We've seen these kind of ramp up in deleveraging efforts coming up from some of the top brass in Beijing.
I think they're doing all the right things. I've just come from Beijing, and again, I would say sentiment there is pretty good compared to previous visits there. I think all the right things, deleveraging, trying to make sure that things just don't grow too quickly, and no, I'm positive on China. I'm positive on the economy in China. Where we find it more difficult is to find the companies to invest in China. That's always been the difficulty.
I can't help but wonder, though, Martin, this latest crackdown from China that we saw in the past week, reportedly asking Anbang to sell some of their overseas assets. I mean, it's not just impending deals that Beijing is tackling now. It's actually more of these already closed private deals. Does it worry you that, perhaps we're seeing some more questions here about the overall strength of the financial system in China?
I think they may be tackling the issue before it becomes a problem. And, we've seen history in the last 20 years when when countries start expanding aggressively abroad and spending huge amounts abroad, it can go wrong. And I think it's very wise to make sure that it doesn't become a problem.
You know, Martin, I just want to get back to a point that you made about, you know, clients and what they're saying and what they're asking you, particularly when it comes to what's going on in Washington with the administration. You know, we had a story out a little while ago about Allianz Bernstein getting calls from lots of their clients asking, when is this next correction going to happen in the markets? Nervous, right, about what they're seeing in the headlines. Did I hear you correctly? You're hearing the opposite from your clients?
No, I think when I said I was speaking about the heads of the big banks in Wall Street are more positive about the outlook than they have been for some time. I would say that clients are nervous about markets, but that's good, because what you don't want them to be is wildly optimistic. I prefer a bit of fear, and we're definitely seeing that. So I think that's positive.
I'm kind of curious to get your take here on Brexit. Do you think, as it seemed like Mark Carney was alluding to, that Brexit is going to be a lot more chaotic, and we've seen that, I mean, as if it wasn't already going to be, but much more disorderly, and that's going to have a bigger impact on the UK economy than even perhaps the original forecasts were?
Yeah, I totally agree with everything Mark said. I think the issue is not inflation, and I agree with him. That's caused by the exchange rate. I think the key is interest rates are not going to go up until we see the conclusion of the Brexit negotiations. Everything is too uncertain, and he's just unwilling, I suspect, with the other 5 that voted with him, to take the risk of starting to put interest rates up now. Why put them up when there's so much uncertainty?
Absolutely. Now, speaking about, you know, Mark Carney was also talking about business sentiment. Martin, I want to just in the minutes that we have with you, I want to talk a little bit about your business, because you're about to undergo a very big change here with the merger with Standard Life. Your shares are going to be delisted. How are you feeling right now?
I think I feel very excited. I think this gives us a great opportunity to compete with the big U.S. houses. We'll be the largest independent outside America, but still just sort of edging into the top 10. So the competition's fierce in asset management these days, and this gives us a chance, I think, to compete on the global stage.
And Martin, there's still a lot of critics out there that say, you know what, economies of scale is not enough to really challenge the rise of passive investing. It's not going to be able to attract, you know, some of the money out of there. It's just a trend that's here going to stay. What's your answer to all of that?
Well, I think it helps compete, but I would say that we're better positioned than a lot of the other big houses that are suffering from the rise of passive, because emerging markets, global equities, there is more scope to outperform there because they're less efficient. So where we're seeing the battle with the passive versus active is definitely U.S. large cap at the moment, and we're everything but U.S. large cap. So hopefully this gives us a great platform to build a great active business.
I thought it was interesting as well. I mean, we've heard people who told the FCA that the rise of passive investing has actually led to a bigger role for hedge funds in determining and setting asset prices, which actually may cause some kind of divergence here when it comes to values and long-term fundamentals. Do you agree with that?
Yeah, I do. I mean, I think the more money that goes into passive, the more opportunity there is to outperform in active, and we see that especially in Japan, where we have a very good active track record, because Japan is so passive that it gives you great opportunity.
You know, this rise of passive investing, though, I mean, it certainly doesn't seem to be going away anytime soon. I mean, begrudgingly, do you find that you're going to have to join this game and join this game big, that it isn't going away?
No, it's not going away, but it's a larger percentage of a bigger pool. So people have to save more now to plan for retirement, etc. But yeah, no, I mean, we have a very good smart beta capability, and rather than compete with the BlackRocks and the Vanguards of this world, compete with them in the smart beta area is going to be our strategy.